All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer some great listener questions. We got some really fun ones, and I think you're going to learn a thing or six about this. So here we go. Let's dive in with the first question. So my question is, how do you guys screen for those bigger red flags when approaching a company? For example, I was looking at First Solar, FSLR, and before I invested, I happened to stumble on the fact that a sizable amount of their cash flow is subsidized from the government. You guys also mentioned an example about companies that miss an audit. What's your method of screening for red flags? Thanks. This is a great question from Jordan. So thanks for the question, Jordan. And Andrew, what are your thoughts on Jordan's question?
Jordan, man, don't get me started on solar companies. This might be a lot longer than we all want. Great question though. Yeah, screening red flags. I would say there's a few metrics that you can quickly breeze through, and then there's kind of deeper things to look out for. But like, how do you think about it, Dave?
Well, as part of my process to find investments, I generally tend to screen for things with the companies. And it's the standard stuff that most everybody does. So it shouldn't be any like rocket science or big reveals. Margins, gross margins, operating margin, free cash flow margin, growth rates of different metrics, looking at ROIC, things of that nature. The other thing that I will do is sometimes I'll screen using some balance sheet ratios, like maybe the debt to equity or current ratio, just to give me a sense of, okay, how is the balance sheet structured? Is it fairly straight? Is it fairly strong, fairly weak, kind of so it's not a surprise. I guess the next thing I do, and I know we've kind of done this on air a few times, is I just kind of walk through the financials. I just kind of pull them up on FinChat, and I literally will just look through the financials of the company and see if anything jumps out at me. And as we've done this exercise, we have come across a few companies that I thought were great red flags. For example, I think it was Goodyear we were looking at a while ago, and they had far more debt than their market cap, for example, which is a huge red flag. And so different things like that. I was looking at a company the other day, and I noticed that they had far more debt than they had cash, or that maybe their equity, their shareholders' equity, was on a steady decline, as was their cash. And so those two things are not great signals. Doesn't mean it's a death knell, but it is something to, okay, note to self, figure this out. Why is this? So those are some of the things I've done. You're the equity analyst here. So what kinds of things do you like to look at, or is there anything you particularly try to find that maybe can lead to a quick no?
Well, to your point about using the different ratios, you mentioned margins, I think, at the very beginning. Mm-hmm. If you're on FinChat, you can go to the financials, and then there's a ratios tab, and they actually have it sectioned out. So you can look at margins and then see all the margins. And then if you see a downtrend, that's usually a bad sign. Capital efficiency, if efficiency is getting worse. And then there's also a drop down for financial health. So even if you don't know what the ratios are, there's a ton of good ratios in there that you can look at right away. And then as you gain more experience and looking at more companies, you'll start to actually understand what those ratios are. But just to be able to even have a dashboard where you can look at those and compare maybe one company to another, I think is a great way. However, there is no substitute for being able to read the annual report, the 10K that companies file, and finding the red flags there's not some easy framework to do that. You really just have to be digging and then hope. Well, in my case, I hope not to find a red flag, because then, usually when you're looking at the company, you're excited and you want to find reasons to buy it. But doing things like reading the 10K, looking through risk factors, reading footnotes, which is can be so tedious and tiresome sometimes, but it's worth the effort. So one of the companies that we had done a YouTube video on called Sunrun, they actually had a metric that they called cash generation. But if you were to read the footnote, that would explain what does cash generation mean, because that's not a gap term, by the way. It's not something that an auditor would find and be like, yeah, every company has a cash generation number. This is a metric that the company had decided to create. And if you read how they create that metric, it's based on cash that they receive when they add debt. And so it is very different. When I think of cash generation, I think of, oh, okay, Apple sold 3 more iPhones and they made a bunch of profit and cash on that. That's not the case there. And so that could be a red flag just all on its own. So you do get better at spotting these the longer you go. I think going back and looking at history, looking at some of the previous bankruptcies like a Circuit City or a WorldCom or a Washington Mutual or a Citigroup, like times where investors completely lost a ton of money. Sometimes looking back and seeing how that happened can be a great way to try to look out for that in the future. But I would say there's a lot of different red flags, and you won't know how necessarily to find them until you find them. And then you just kind of have to use your ability to feel anxious or listen to the cues that your body or your mind is telling you. If something seems murky, then listen to that feeling and move on, because there's, like Dave always likes to say, there's plenty of stocks that we can all look at and buy.
Yeah, for sure. Those are all fantastic ways, and I don't think we can hit the nail hard enough about reading the 10K, because that will reveal all, and mostly because they have to. And sometimes they may not say all the words, and you have to use a little bit of interpretation. But again, to go back to the Sunrun example, when I was reading through that and I came across that cash generation, that was kind of shocking to me. And the more I kind of researched what they were talking about, and the more confusing it was, and the more gobbledygook that they used, those are all signs to investors that they are revealing what's going on, but they're not really telling you, or they're trying to obfuscate or obscure the message by using either big words or words that, word salads or any of those kinds of things. And it can make it really complicated. And the more they do that, the more that should tell you subliminally that they're trying to hide something from you, or they're trying to make you, okay, I'm not going to dig into this because they don't want you to look that close, kind of thing. And it doesn't just happen at Sunrun. There's other companies that kind of thing happen to. And the last one that I would mention to give you some clues would be when you're listening to the earnings calls. Every company gives out quarterly. A lot of times, what the analysts seem to focus on, sometimes they could be like a pack of dogs where they just attack one position or one particular thing, and each one is trying to ask a different version of the same question over and over and over again. That could be a clue to you that, hey, there's something going on here that it's most likely not good, especially if they're really focusing on it. So that can be very, very helpful. And you'll also find that some analysts that are in an industry may be better than others. And so you can just kind of focus on what they ask to, and that could be, those can give you some clues on what's important about the company, good or bad. But I've noticed if there's a company that's in trouble and you see a lot of analysts really kind of going after them about a particular thing, then that can be a red flag as well. And that could be something to, okay, note to self, I need to go to the 10K, figure out what the heck is going on here. And if it really is that bad, then okay, it just saved myself a lot of headache and heartache.
You can almost hear it in the tone sometimes too, right? Like
right.
the building frustration or tension.
Yeah, for sure. I've noticed that too. I like to go for walks and listen to the Quarter app and listen to earnings calls, and you can pick up a lot by the tone, not only of the analyst but also management. You can tell how irritated they may be getting about all the questions, right. And that can tell you a lot too.
Yeah, that's good.
All right, so let's move on to the next question. So this is from Klaus. This is a great question. How do you build a watch list?
Yeah, watch list, super important. It can be very helpful in giving you that extra push when stocks go down and you're ready to pounce. I mean, I've kind of built my watch list over the years just through any way that I imagine a lot of people would, like listening to podcasts, hearing an idea get thrown around on a podcast, or even sometimes seeing something on CNBC and being like, oh, I'm going to jot that ticker down, do some research later. Everyday life, talking to people and hearing what are the companies that they think are really, really good. So many different ways to find ideas. And then, of course, yeah, you screen for them too. But yeah, I think there's a lot of power in just collecting those over time and trying to review them. And I know like Starbucks was a good example. It's not a great one to talk about for me personally because it doesn't like make me look good. They haven't been doing so hot lately, but that's one of those that's kind of always been on the watch list for a while. And so when my conviction can start to waver a little bit, I can remember, oh, it was on my watch list a long time. It's just you get a lot of different emotions when the stock price moves if you own the stock or if you don't. So dealing with those emotions and trying to add companies to a watch list and realize, okay, these are like some of my favorite companies, my favorite businesses, I think is a powerful thing to do just with your emotional state.
Do you like to organize the watch list, or is it just kind of a running commentary of, okay, these are all the ideas that I've come across? Or do you like to okay, these are dividend players, or these are growth players, or these are industry things or utilities kind of thing?
Yeah, I mean, I if you looked at my folders, you would most normal people would probably just start to panic because there's just spreadsheet after spreadsheet after spreadsheet. Really, the only organization that is consistent is the fact that I always put a date, which is so pointless because you can see the last time a spreadsheet was modified. But I like to put the initial date there for whatever reason. And then, like, my brain can kind of think, oh, yeah, that was back last fall. I'll look at all my spreadsheets from last fall. But yeah, for a long time, it was a mix of Post-its and Excel spreadsheets. Now I just use the dashboard in FinChat, and so that keeps them all in one place. But for the longest time, yeah, it was just everywhere, and I would get so frustrated trying to find, like, where did I put that one company? I know I did research on it. I know I had some research on it somewhere. Yeah, that can drive you nuts. When I did ASML, for example, was a stock we bought recently. I know I had done work on that entire industry. So Lamb Research, KLA Corp. And I'm not kidding you. I think I spent like an hour trying to find those notes. But when I finally did, like, that was awesome because that was hours of work that I could then go back and reference, right? But yeah, I think using FinChat's a good one. I think if there's other people like me who are doing paper notes, which would be insane, there has to be some better solution other than getting a personal assistant to manage my notes. Like, come on, there's got to be a better system than that.
I've seen them, folks. It is terrifying. I try not to look at it when I go over to Andrew's house because it just gives me too much anxiety. So I just choose to ignore.
What about you?
Yeah, I have probably gone every different route you can think of, building a watch list. I think I've settled on, over the last year or two. Our friend John Rotanti was on the show a while back, and one of the things he talked about during our episode that really kind of stuck with me, and it's still stuck with me, is kind of creating a watch list of what you think are the best companies out there. And when you're looking for ideas to invest in, or you're just looking for things to air quote work on, is return to that as your worksheet. And to your point, looking at a company like ASML, even though you may not own it, if you do the work on it, at some point you may get the opportunity to own it. And when that opportunity comes along and you've already done the work, then it just makes it air quote easier to make that decision. So I've started to try to do that. So I actually have two. So I have what I think are the air quote best companies out there. And then I have a second one that is just kind of a running thing, like you're talking about, like, oh, I didn't know they were public, or I see something in my cupboard, or I go to the grocery store and go, I really like that product. I had no idea they were public. Those kinds of things. And I'll just kind of keep a running list. Or if I read a blog post or you mention something that you're working on, all those things will go on a watch list. I have two. So I have what I think are the best, and then I just kind of have a ragtag muffin, just, smorgasbord of just, all kinds of things that get plastered on there. And sometimes I'll look at them later and go, ooh, no. Why was I? Yeah, no. Even if I just pull up all the financials in FinChat, and because that's what's nice about it, is I can just flip to the financials and go, nope, 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 nope. Okay, bye bye. It just makes it easy in that respect. So that's kind of how I've learned to do it over the years.
Yeah. I like hearing or reading other investors,
Mm,
the hedge fund people
yeah.
or super investors, for lack of a better word, the well-known, well-followed names,
Mhm.
what they own, and then when they talk about them, some good names in there. Obviously, I mean,
Yeah, right.
smart people who run those portfolios. So
Yeah. Yeah. I like to do that too. I know some people like to look through some of the 13 Fs that
mhm.
investors, some of those super investors will put out. And I know in FinChat they have that as well. So you can kind of look through the portfolios of those people. And sometimes that can be a nice way to kind of mine for ideas. Not necessarily that you want to follow Tom Gaynor or Warren Buffett or Joel Greenblatt into a position per se, but it can be helpful to go, oh, okay, I didn't know they own that. All right, well, if they like it that much, maybe I should look at it.
Yeah, I probably look at the news a little bit too much,
Mm,
but sometimes that can add things to the watch list as well. Like,
right.
oh, this thing is down 15%. Okay, is it finally cheap enough?
Finally cheap enough. Is Costco finally cheap enough?
Never.
We can only dream and wish.
Yeah.
All right. So here's a great question. So this is from Robin. So how do you like your CEOs? Boring or charismatic?
Oh, yeah, I like them with some Riz. You know that one, Dave?
Okay,
Have you been
so you're
educated on
gonna
that
have to
one yet?
explain that to the old person in the room because I've heard that word. I've heard my daughter say that word, but I don't speak that language. So you're gonna have to
Yeah.
explain that to me.
Well, I'll give you a hint. It is related to the charisma thing, so
Okay.
I'll let your daughter fill in the gaps for you.
Okay.
Uh, yeah, interesting, right? I don't know. I If I had to choose, I'd probably choose a boring CEO over a charismatic one, simply because like I can't imagine. And I bet a lot of people would say Elon Musk doesn't fit in the charismatic bucket, which that's your own opinion, but like still, the charismatic type of CEO will tend to have a lot of attention and have a lot of people who pay attention to what they say and maybe talk positively or negatively about this person. But just imagine being a Tesla shareholder during this time where Elon's constantly in the news. That is that is tough. So I would prefer as a shareholder not to have to deal with that, and that's why I would say I'd like the boring CEO.
Yeah. I will default to the boring ones as well. If I think of the companies that I like the most, the companies that I own, the companies that we own, the ones that I like the most generally are the CEOs that aren't in the news a lot. And I think that it can be very helpful in that respect, in that the company doesn't, it's already going to gather a lot of attention if it's really performing well. And having a CEO out in front just attracts more attention. And I think it's better to fly under the radar a little bit because then it's, capitalism is going to attract attention anyway. So if a company is successful, other people are going to want to replicate what they're doing automatically. And so I think if you fly under the radar a little bit, it maybe can stave that off a little longer, perhaps. I guess I probably default more to somebody that's a little less uh, if you will. But I guess that's kind of the way I try to think about it. I mean, if you think about our favorite CEO, Warren Buffett, kind of boring. I mean, he's
Yeah.
charismatic, but he's certainly not making news much.
Right. Right.
The guy that runs Costco, I don't even know his name. That's how under the radar he is. Um,
Yeah.
the guys that run Visa and MasterCard, very under the radar. Uh, I just prefer them over other people. And I just think especially when things are going poorly, I think it'd be helpful not to have a charismatic CEO because they can sometimes step in it or put their foot in their mouth a little bit more than they probably should. And that sometimes cannot help the situation either. So,
Yeah.
all right. Okay. Let's move on to the next question. So we got This is a fun one. So, how do you build an industry map, and what do you think is important to include?
Okay, so what I would do first is I would read the 10K of the company I'm looking at. And that sounds obvious, but it actually is a very important first step rather than just kind of shooting from the hip before planning. Because if a company actually has multiple segments, then you might start going down the wrong path and then you have to redo a whole new industry map. So you do have to be careful about that because companies will have more profits or segments with more profits than others. And maybe you want to start with that industry map first before you do a different one. I think Amazon is the perfect example of that, where their AWS actually drives more profits than their retail side. So, you would look at Amazon and start looking at Costco and Walmart and all those guys, but you should have started with the cloud computing. So that's the very first step. And then the next thing is, depending on the company, some of them will put who their competitors are. And so if they are listing out those competitors, then there's your to-do list of next 10Ks to read. And so you start to build the industry map that way. And sometimes, maybe the company you were looking at doesn't have too much information, and so you're getting a very small picture, but then maybe the competitor is in different business units and they kind of have a broader business, and now you're getting a bigger picture by reading their reports. So I would do that. And depending on the industry, sometimes that can be a lot of fun because you're learning all these new things about a particular space, but that can also feel overwhelming as well. So if you can have expertise in adjacent industries, that always helps. If you understand the distributors of an industry, that really helps in trying to understand the OEMs, or the people who are actually manufacturing the stuff. And I would argue if you're looking at an OEM or distributor, those two go hand in hand. Like if we're looking at the HVAC industry and you have Carrier and if you have Carrier and Ream and some of the other big players, and then you also have the distributors, Watsco and the small companies, you want to understand what those dynamics are. How big are the relative sizes? And that's hopefully what the industry map will show you. And then as you kind of build out that picture, then you can start to get into the numbers and get into the metrics, get into the charts. Those charts will make a lot more sense and they'll give you more information. So if I'm looking at this company versus this company versus this company, and where are their revenues over the last 3-5 years, that becomes more helpful if you understand their place in the industry and what role they play, rather than just random collection of companies with different growth rates. It doesn't tell you much.
Right. That's interesting. So, I guess two questions come to mind. Number one is, does something like a TAM enter into this realm at all? And then I guess the second question would be, how do you determine what's the right thing to try to focus on? And I'll give you an example. So you mentioned Amazon. If you're looking at Amazon and you're trying to compare them to Walmart and Costco, do you look at the retail side of it and compare that to Walmart's and Costco's and maybe Kroger and other people's, their retail parts of the business, and just kind of exclude the AWS? And how do you think about that?
That's a really good question. And it kind of shows why it's important to really know the business as much as you can. That's why I say reading the different annual reports will help you fill in those gaps in information you might have. So, to use the Amazon example, figuring out their TAM or their industry would be really hard on the retail side. They are the everything store. And so that TAM is massive, and you really can buy anything and everything there. So I think the closest parallels of Walmart and Costco are pretty decent there. But then, yeah, to your point, you also have all the grocery, and grocery is kind of fragmented. Like there's a lot of regional groceries companies. And so Yeah, that can be hard. When I think of TAM, I think of it very selectively. I don't think of TAM in the same way. I think of it differently depending on what industry you're in. So some of the TAMs I might take a company's word for it, and other TAMs I might be like, okay, that sounds too much. And that's just a judgment call. So when Dick's Sporting Goods says that, hey, we've only penetrated 7 or 8% of our TAM in the US sporting goods retail market. I kind of take their word for it. I look back over history that's consistent. They haven't changed the number from 9 to 50 or whatever. It's a consistent, steadily growing number. Okay, so I believe their market share numbers. I believe their TAM numbers. But then you have other companies who may have said their TAM is $3 trillion. Not going to name names, but it's like, come on, like let's get realistic here. So that's kind of how I think about TAM. And on the cloud computing side, I mean, I don't know if this was the best thing to do, but I kind of looked at when I was looking at Microsoft Azure's potential TAM. It's like, okay, well, who are the legacy players in that in cloud? And it was IBM and some of those guys. So what were their revenues like? And then how does that compare? And how much can Microsoft potentially take? So like with everything that we talk about with finance and the income statement balance sheet, it's better to be approximately right than precisely wrong. And so you're just trying to understand differences. And when you start to understand differences, then you can understand that, okay, Coca-Cola at a 40%, 50% market share, or whatever it is, has a very different growth story than Crocs, maybe at 1% of their TAM. You just get, when you start to see the extremes of like lots of growth left, not so much growth left, huge market dominance, really small marketplace market, and so you can use those pieces of information to help you craft your narrative about how you feel about a company.
Yeah, that's awesome. So, are there any things that when you're kind of trying to build this out that you try to include for all of them because you think that this is important information I should know to compare other companies, or is it more industry by industry? Like if you're looking at semis, you got to do it this way. If you're looking at grocery, you got to do it this way, kind of thing.
Yes, both.
It depends. Okay.
So
check.
there are the things that you want to keep consistent, and you could even call them habits if you want to call them that. So things like valuation, things like free cash flow, things like how is that free cash flow growing? That's got to be consistent. That's any stock you buy. We got to look at that for every stock you buy. Things like the competitive advantage, what is the moat? What sets them apart? You got to look at that for every stock that you buy. And then expanding it out industry by industry, going back to our Amazon example, maybe it's not that important to try to figure out how big is the everything store, because your chances of getting that accurate to even to the billionth of dollars is probably very slim. But maybe that is very relevant for like a pharma, like a McKesson or a Cardinal Health or Pfizer and Novo Nordisk. Like those maybe you care a lot more about because it's a lot more quantifiable because all the big competitors are all public. So that's kind of, I think it really depends. It depends on what question you're trying to answer and how much information you could potentially have. I think it's dangerous to just Google search things all like, I'm going to go down these rabbit holes because to be frank, there's a lot of just bad information out there that people say, oh, well, this industry is going to grow to this much, or that industry is this size and it's going to grow that much. It's like, a lot of that stuff is just guesses and some of it's wrong. So sticking to the financial statements, stuff you'll find in FinChat under the filings tab, 10K, 10Q, 8K, proxy statements, stick to those things that we know are public, that we know have to be audited, and that's as close to the truth that you can get. Mm-hmm. And you just have to be okay with it's not going to be perfect.
And it's also not going to be easy. There isn't. I have discovered there's not an easy button to that part of it.
Right. Yeah. Good point.
I guess something else that's I think is interesting about industry maps and how much they can help you. Have you, in your experience, have you come across, maybe you're looking at one particular idea and after building an industry map, you find a company or two that you liked better than the original idea? You don't have to name names if you don't want to. They could be anonymous.
Yeah, totally. I don't know if this is for a fact because my memory fails me. This was like 2, 3 years ago, but I'm pretty sure Watsco happened because I looked at Carrier first. Pretty sure that's what happened. But yeah, I mean, stuff like that happens all the time.
Yeah. I think that's a really interesting. Is there any other place that you would suggest people go to try to figure out if the company doesn't reveal in the 10K or other sources maybe who some of their competitors are?
Yeah, I mean, I don't know. It's tough. What do you think?
For me, there's probably two places I would look. They're both gonna lay in the FinChat world. One is they have an industry tab that you can click on, and they will lay out some of the companies on there, so that can be useful. The other place I like to go is a proxy. I know that's probably the least favorite document for most people to read. There is a lot of jargon in there, and it can be tough to slog through, but there is a section on CEO pay and just management pay. And in that, most companies, I think I've only found maybe one or two that didn't have much, if anything, that they will list out who their competitors are. And they do that because they're trying to base how much they're going to pay their people on people that they feel like are similar to their businesses. And that can be a really, really good place. And sometimes you'll find 5 names, sometimes you'll find 50. It just kind of depends on what they consider their industry. And so that's kind of been my default, is to just kind of go there. If I can't find it through the 10K or through FinChat, I'll go to the proxy.
Yeah, I think to your point about, I can't remember if you had said this before on the show, so I'll repeat it. If you notice that there are analysts who are on the same calls, then searching to see what other calls those analysts are on, through the transcripts and everything.
Yeah.
So it's like, okay, this guy is the sporting good. He's on all the sporting goods retailers calls. He's whatever call he's on, I should probably be aware of that company, that kind of thing.
Yeah, for sure. I have specifically noticed that in the payment space, because I spent so much time looking through there, that there were half a dozen, if not more, analysts that were very focused on that industry. And so you'd always see their names popping up over and over and over and over and over again. Mike Mayo, who we've mentioned before, is a big bank analyst, and you can use him to find out what other banks he's covering, and that could be very helpful too.
Mm-hmm.
And he's entertaining.
And he has a good book, by the way.
He does. Yeah. I agree.
Have you read it?
No, I haven't. I've heard it's good, but I haven't read it. Have you read it?
Yeah, you should check it out. Yeah.
Okay.
It's called Exile on Wall Street.
Oh,
so
interesting.
That's going to appeal to me because
right.
The outsider I am.
Yeah. And now that Jamie Dimon is, stepping down, that's one of the things I think is going to be missed on Wall Street. Are there the fireworks between those two?
Right. Another rivalry hits the dust. Huh?
Yeah. Right. It's maybe not quite to the level of like Dodgers Yankees, but it's pretty good.
No, I thought it was like Biggie, Tupac, and then Jamie Dimon, Mike Mayo. No, is that just me? Okay, all right.
Maybe. All right. Well, with that, folks, we will go ahead and wrap up our show for today. I hope you enjoyed answering all those questions, and shout out to all the people that sent us those fantastic questions. If you have any questions you'd like us to answer on the air, please reach out to us at newsletter@einvestingforbeginners.com. You can also leave us questions on the Spotify app, or you can send us questions on the socials, i.e. the X/Twitter machine and LinkedIn in particular. So with that, we will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.